Today's video, I want to discuss the current state of mortgage rates, home building, and what does the future hold for 2022. Let's do it. U.S. new home sales decreased by 2% to an annual rate of 772,000 in February. The data showed this week. That figure represents the number of homes that would be sold over a year-long period of time if the same number of properties were bought each month based on the rate of sales in February. So pending home sales declined for a fourth consecutive month, folks. Looking at some of the research, the National Association of Realtors, here's a quote from an economist at the NAR, Lawrence Yun. He's a chief economist for the National Association of Realtors. He attributed the index's decrease in February to the low supply of homes listed for sale. Well, absolutely, Lawrence, you're spot on. Buyer demand is still intense, in his opinion. I'm seeing that with my clients in and out of California. But it's, as simple as one cannot buy what is not for sale, he said, adding that he expects a 7% drop in home sales in 2022 versus years prior. So mortgage rates, I did a talk on this, and mortgage rates from the data and the economists are likely to push towards 5% before the year end, and rates soared to their highest levels in over 3 years, putting pressure on home buyers. The effects of the rapid rise in interest rates are already being felt in the nation's housing market. If we look, compared to a year earlier, sales were down more than 6%. Economists expected new home sales in February to drop to an annual rate of 805,000. So what is going on? What is going on? The supply of new homes for sale rose between January and February to roughly a 6.3 month supply of units. And then in January, new home inventories were already at the highest levels since 2008. So on a regional basis, new home sales varied significantly. If we look at the Northeast, recorded roughly 59% uptick in sales, while the figure for the West declined by 13%. So the average sales prices for a new home sold in February was roughly $511,000, while the median price was $400,000, a little over 600 bucks. So if we look at the holistic picture, home builders have maintained a steady pace of construction. It's been a little up and down. Costs have gone up dramatically, which would likely be faster were it not for the impact of the supply chain headaches and a tighter labor market right now. Supply chain is out of control. And data on February housing starts earlier this month signaled that builders were continuing to ramp up home building activity. I saw some data where they pushed back. They really hit the gas and then they let off, and now it's kind of steady. So the U.S. is in the midst of a major housing shortage, and it's been going on a while, which should continue to provide a strong foundation for home sales, even if the rising rates cut into the demand. In my opinion, the growing, built-to-rent market also could provide leeway for construction companies to maintain their current pace, even if the broader housing market slows slightly, which is what we're seeing. So, mortgage rates are racing towards 5%, and who we need to keep an eye on. The Federal Reserve's expected trajectory for future rate hikes became clear. We heard what they said, 6 more plus. So if we look at the 30-year, the average rate on a 30-year fixed rate mortgage was roughly 4.42% as of the week ending March 24th. That representing as an increase of 26 basis points from the previous week. That's from Freddie Mac FMCC. So that's plus 0.61 reported. That was reported on Thursday. So 1 basis point is equal to 1/100th of a percentage point, or 1% of 1%. Well, mortgage rates continue their climb, with rates hitting the highest in 4 years, closing last week at 4.46%, and some other data I looked at. But remember, if we look at history, our rates are still historically low. Last week was the first time since May 2019 that the interest rate on this benchmark mortgage produced, their products had, surpassed roughly 4%. So following this steady rise of the bond yields, I've talked about this, including that on the 10-year Treasury, 2.357%. Rates rose, even higher. So if you want to put this in perspective, cap it off, this was the largest 2-week gain for the 30-year mortgage rate since 2009, and one of the largest such gains in the history, and that's according to the historical data from Freddie Mac, stretching back to the 1970s. So the average rate, if we curtail it down from 15 or 30 to 15-year fixed rate mortgage, increased 24 basis points to 3.63%, while the 5-year Treasury Index Hybrid Adjustable Rate Mortgage rose 17 basis points to an average of 3.36%. So many Americans are already seeing interest rates that are much higher on home loans, given that the number reported by Freddie Mac are averages. So the main takeaway, folks, is that mortgage rates are likely to push towards 5%. So you need to know that. You need to convey that to your clients before the end of the year, with lenders, anecdotally reporting quotes around 4.75 for 30-year fixed. I'm able to get under 4% right now. I got a few quotes under 3%. That's a special lender that I deal with. So there's some deals out there as far as the rates, but still historically low. With the median sales price of new homes up, and only roughly 1 in 10 new home sales sold for less than $300,000, compared with 3 in 10 new homes in this price range last year. A new home is not an option for many first-time home buyers, even before the impact of higher mortgage rates is considered. When you look at the data and what economists are saying and what I'm seeing out there. So because sales will be sluggish right now, it does not necessarily mean that residential investment will be as well. Okay, so we know that builders have a lot of work to do to catch up, and if anything, to the extent that the higher rates keep people from moving, it will tend to push people to do renovation work on their existing home. And absolutely. So when we look at this going forward, what do we need to keep an eye on? We need to keep a solid pulse on what the Fed is going to do. That's primary. So a lot of people look at it's all about the Fed. What is the Federal Reserve can do? Investors and lenders are reading the tea leaves as the Federal Reserve considers its next move. Who knows, every week they change their mind a little bit. Jerome Powell, the central bank hiked rates for the first time, as I indicated before, since 2018, earlier this month, but already members of the Central Bank Committee that guides interest rates policy are considering even more substantial hikes in the months to come. So on Monday, the Fed Chair Jerome Powell, JP, said that the bank would consider rate increases larger than 25 basis points because, JP, the first one was a joke. In the coming months, if it is necessary to tame inflation, which, as JP has been saying for a year and a half, has been transitory. So it's good news. He should have been saying that a year ago, because that's what I was seeing. So investors will be focused on any clues from the Fed regarding the magnitude of the future rate, because that's huge for investors, for rate increases and the pace of balance sheet reductions, which could further impact rates in the coming weeks. And that is from the Vice President of Zillow, Paul Thomas. So, and that's what I'm seeing with other economists in the micro data that I'm delving into. So the timing of these increases could throw a wrench in the housing market's gears, just as the the popular spring home buying season is getting underway. So I have some buyers right now outside the state of California that are kind of putting the brakes on. And I have some people moving to Vegas from California, which is good. But my buyers in Vegas or in California are putting the brakes on right now. Already a family buying a medium price home will be spending over $300,000 more per month on their monthly mortgage payments than they would have if they had purchased a home a year ago. So those people buying a home $1 million or less, they're more budget conscious. They're not coming in paying cash. That's a big chunk, an extra $300 a month. So that's just the run up on mortgage rates and home prices right now in the last year. So still, and I want to emphasize this, many homeowners and investors have figured out that if you are paying 4.5% interest on an asset, that is increasing in price faster. It's a good deal. And everything seems to be going up faster than 4.5% right now, ladies and gentlemen. Gasoline, food, clothing, everything. Without housing, stocks limited, and new housing needing to purchase supplies at increasing prices, new homes can only go up in price. And I've been saying this, the homes are going to go up in value. There's going to be an equity increase position over this next year, and rents are going up. So, for buyers and sellers, this spring will offer a period of transition in which high prices will combine with rising interest rates to challenge budgets for people, in that lower bracket, already contending with this high inflation that is higher than inflation. It's hyperinflation, and that's what the economists are saying. And it's going to be a challenge for sales of both new and existing, homes down the road. So the inflation is a concern, the food prices, the breadbasket of Europe is Ukraine, largest wheat producer. Ukraine has the largest natural resources in Eastern Europe, so there's been a fight for that for 17 plus years. So this war is concerning, but like I tell you, when it comes to the stock market, which is like water and real estate is like boulders, you look at the history of interest rates. Historically, since the 80s, we still have historically low rates, and a home is still a solid investment. I can't emphasize that enough to you people. I feel more comfortable putting my money in assets that I can touch, and I know if I'm putting enough down, it's cash flowing. If not, or it's your primary and you're a first-time buyer, you're going to gain an equity increase this year, and in my opinion, going into next, because inventories are very low compared to 2008. More people are sitting on equity. In the era of transparencies, foreclosures are up across the country, but I am also seeing a lot of people pay cash for properties, and I'm talking $2, $3, $4, $5, $6 million. And I just don't follow California. We're doing stuff in Wisconsin. I'm helping someone out there, and there's multiple offers on properties over $2 million in Wisconsin and Chicago. I'm looking at Boise, Idaho. So I'm on a conference call pretty much every day for another state. So I'm on a conference call later today for Nevada, and Nevada's up 35%. I was just in Arizona last week looking at investments, learning more about the market. They're up. So you're an investor, Florida, Nevada, Boise, Arizona. Boise is a little overinflated. I'm going to do a talk on that. But I like Nevada. I like Arizona. But California, there's no inventory. There's no dirt. And I'm seeing, I'm looking at ultra luxury with some clients, and I'm also dealing with some lower end clients, and the luxury stuff is selling right now. So yes, you have people that come in and pay cash. They don't care about interest rates. But it's a very convoluted market right now. You have to be very creative out there when you talk to your clients and understand the data. So hey, have a great weekend. Take care.